Welcome to Business Connection. I'm Liz Spencer. We have wonderful guests in studio. It's Pete Zich. He's the principal of Dugan and Lopatka CPAs and consultants, and he's joined by Andrew Schmidt, who's the tax manager there. Welcome.
Thank you.
Thank you.
It's good to be here.
Well, thank you. It's fascinating. We have a new tax act that some of us thought about when it was happening in January, and now we're a little long, into the first quarter, and we're back. So, Pete, let's start with you. What are some of the objectives that we need to know about this tax reform and now the Tax Act? How's it going to play out?
I think there were two objectives when they passed the Tax Act. One was a tax cut, both for businesses and individuals, and the other was tax simplification. And on the first agenda of a tax cut, I think they achieved that primarily for businesses, and Andrew will talk about that, and to some extent for individuals as well. But on the tax simplification, they didn't come close to that. I think, if anything, it's more complex because of some of the new provisions they put in. So they win on one, they lose on the other.
Okay, well, 50-50.
50-50 is not all bad.
Not bad. And what got the most attention in that Tax Act? What was really moving us to...
Initially, if you go back to when this passed, which was at the end of December, one of the big things that got a lot of press, especially in Illinois, was this idea that I have to rush out and pay my real estate taxes, because one of the changes in the tax law was they put a cap in that the most you could deduct as a miscellaneous itemized deduction going forward was $10,000, combination real estate taxes, income taxes. So because of that, especially in DuPage County where real estate taxes tend to be higher, people were concerned that I'm not going to be able to deduct my taxes next year, so everyone rushed out without knowing if these deductions would be allowed. We've since found out from someone in D.C. that, yes, for Illinois specifically, anyone who prepaid their real estate taxes was allowed to take that deduction for 2017.
Well, and that's good news.
It's really good news.
At least going into this year. There's
Yes.
still, it doesn't necessarily help them going forward, but it's still good news. So, Andrew, tell me a little bit about what, specifically, how does this impact business in the collar counties?
Well, for businesses, C corporations, their tax rate was lowered from a top rate of 35% down to 21%. Under the old law, there was a graduated rate, so it depended on how much income the corporation produced during the year. So you could have a corporation that actually paid a 15% tax rate because their income was lower. That will now see a tax increase up to 21%. But overall, it is a great cut for businesses, down from the top rate of 35 to 21%.
And when you say C corporations, give me an example. Who falls into this? What types of businesses?
So this could be any type of business. It could be manufacturer, a distributor, but the main thing about a C corporation versus a pass-through entity, which Pete will get in on in a little bit, is that there's two layers of tax. One at the corporate level, and then again when the owners receive a dividend, they have to pay tax as well.
That's awesome. So, and does this apply for all businesses?
All businesses organized as a C corporation.
Okay, that's great. Well, that'll help somewhat.
It will. Yeah.
Does that go to this? Does that make it simpler for businesses with this type of reduction, or does this complicate it?
I think from that perspective, it does make it a little simpler, because these owners that had C corporations used to try and plan their year end to get to a certain targeted level of income to try and achieve the best possible tax rate, and now they won't be doing that anymore because it's a flat tax rate. But you talk about companies that have income. One other change that came about is companies that have a loss. So these same C corporations, if they have a loss, we refer to it as a net operating loss, or an NOL. So if you have one of these losses, what you used to be able to do was carry it back 2 years, and if you had income in those years, you could get a refund. They've taken that away. The other thing they've done is they allow you to carry it forward to offset income in future years, but they don't let you offset dollar for dollar. So as an example, if you had $100,000 of income next year and you had this $200,000 net operating loss carry forward, you would think, I'm not going to pay any tax because one offsets the other. But the rule going forward is you're only allowed to offset 80% of your income. So you're still going to pay tax on $20,000 even though your loss carry forward is larger than that. So that's a change that business owners are not too excited about.
No, I can't imagine they would. And it's funny, as I listen to you in that, and I think, wow, a tremendous amount of change, and that makes me even more excited to meet you and know you, because that's why we have you. That's why we have you.
It's good for us.
Yeah,
We
makes
want-
planning very important.
Right. It is about planning, but what are some other key provisions in the legislation for business that we need to think about?
Some of the bigger things are in the depreciation arena. So this is large capital expenditures. Companies like manufacturers and construction contractors that have large capital requirements, they're now going to be able to write off up to $1 million
Wow.
of any capital purchases that they make during the year. Under the old law, it was limited to $500,000. Additionally, for now new and used equipment, they're increasing the 50% bonus depreciation. So you could deduct 50% of a piece of machinery in the first year that you place it in service. Now you can deduct up to 100% of that. And under the old law, that required you to purchase a piece of new machinery. Now you can use used machinery as well.
That's awesome. Being a small television station with lots of gear, we understand depreciation, and it impacts us. So we get it. So tell me a little bit. What should owners be thinking about right now, business owners, as we passed the first quarter of the year, and so what should we be thinking about with this new tax law?
Well, I think in general you want to be in touch with your CPA, because you want to understand the law and still act on it while you have that chance, because there's still 8 months left in the year. But specifically for me, and I guess for our firm, what we see the most of is businesses that aren't C corporations, what Andrew was talking about before. And what we're talking about is flow-through entities, and those could be S corporations as opposed to C corporations, partnerships, and limited liability companies, or LLCs. And with all those type of structures, rather than the entity itself paying the tax, what happens is the income goes out to the owners, and the owners report it on their personal tax returns. So from that perspective, the owners aren't seeing the big tax cut that a C Corp sees. But what was put in place, and what we think is probably the key provision in the Tax Act, is this 20% deduction for flow-through entities. So when you're reporting that income on your personal tax return, you have the potential to get a 20% deduction of that income, which effectively is the same thing as a 20% reduction in the tax rate. So it's a great provision that's out there, and if you're self-employed, it would also apply there, and there's lots of people that work out of their homes. So again, they have that potential to not pay tax on 20% of their income. So from our perspective, that's probably the biggest benefit that's out there. And that also applies to someone who owns real estate and they're collecting rental income. So again, it's a great provision, but it's also extremely complex. They haven't issued any guidance. We're getting questions from our clients that we're saying, well, we think it's this way, or we hope it's this way, but we don't know yet because we're still waiting for more guidance on this. The one potential negative to it is just like a lot of things in the tax code that they sound good. Once your income hits a certain level, they take it away. And this is one of those situations where if your income hits a certain level, they take it away. If what you're doing is like what Andrew was saying before, if you're an accountant, if you're an attorney, if you're a service provider, once you hit that certain income level, which is $315,000, you don't get this deduction anymore. If your business is something other than services, you still get the deduction, but now it's a test where you look at what's the greater of. Is it the 20% deduction, or you have to do this test where you factor in all the payroll that your company paid, all the fixed assets that your company owns. You go through some computations there and you figure out which one gives you the answer. So it's very complex.
I think what comes to mind is is to really talk to your accounting team much earlier than you might in a normal year. This is not going to be a normal year in 2018 when we put those taxes in. So I think that's
absolutely
the key walk away for me, is start talking to you guys sooner. So I can't thank you enough for stopping by and sharing a lot of insight on what we need to be thinking about, both the pluses and the minuses for this new day for our taxes.
We appreciate the opportunity, because it really is important to talk to your CPA.
It is. We'll be right back with more Business Connections. Stay tuned.